Principal, Dr. Sister Maggie Jose, the resource person of the day, Dr. Sony Tomas, my dear teachers and friends. I invite you all to the national webinar on investment portfolio hosted by PG Department. Let's begin our program with a silent prayer. Now I welcome our HOD of Commerce Department, Ms. Ruji Mehta, for the welcome speech.
A very good morning to one and all, and thank you so much for joining us in this program. It is my great honor to welcome you all to this national webinar on investment portfolio, which is organized by the PG Department of Commerce, St. Mary's College, Thrissur. On behalf of the department, I would like to welcome our beloved principal, Dr. Sister Maggie Jose, in her absence, whose blessings and love has always been with us. I'm very honored to welcome our resource person of the day, Mr. Sony Tomas, Associate Professor, IIM Kozhikode, who readily accepted our invitation despite his busy schedule. He is a man with exceptional experience in the field of investment analysis and portfolio management, equity research, and financial markets. Prior to joining IIMK, he worked as a senior research analyst with Deloitte Research and as a scientist with GE Money MSME Financial Decision Sciences Lab. Further, he has also conducted various training programs in finance for private as well as public sector companies. Definitely, he is going to be a true source of knowledge for all of us. It gives me immense pride in welcoming you, sir. I also take this opportunity to welcome all the faculty members and the participants from various areas across the country. Once again, I welcome each and every one of you present here. Hope you all have a very fruitful time. Thank you.
Thank you so much for your valuable time, ma'am. Now I welcome our resource person, Dr. Sony Thomas, to begin our session.
Yeah, thank you, Christina, and thank you, Professor Ruji, for that introduction. So very good morning to all of you, all professors, research scholars. Today I'm going to talk about the relevance of including commodities in an investment portfolio. Since there are BCom students also attending the seminar,
Hello.
Sorry for that interruption. Can you hear me now?
Yes, sir. It is audible now.
Everything is fine, right? So even if there is some interruption, right, please wait. We'll settle that. Okay. Yeah, hope it is fine now. I'll start sharing my screen. Everything is fine, right? Audio, video, everything is fine?
Yes, sir. It's audible. It's audible.
Right. Are you able to see my presentation?
Perfect, sir. Perfect.
Right. Okay. Sorry for the disturbance. I think some disturbance happened. Right. So let me start with my presentation. I'll be talking on why commodities should be included in the investment portfolio. So I will present for roughly 30 minutes. After that, if you have some questions, I can take those questions. And we'll see what we can best utilize this session for. Okay, so that's fine. So why commodities should be included in an investment portfolio? That's what I'm going to talk about today. So hope all of you are familiar with a portfolio. So what is a portfolio? Portfolio is basically a combination of various assets. We talk about creation of a stock portfolio where we can create a portfolio using various stocks. Or portfolio could be created across various assets. What are these? We can create a portfolio of stocks, bonds, or commodities like gold. So these are the popular ways of creating a portfolio. So what is the significance of a portfolio? So that's what I'm going to talk about first. And if you look at this portfolio, the most important advantage is maximizing the return by minimizing the risk. So when you are making any investment, you are interested in maximizing your risk. But one of the important features of a portfolio is creating a portfolio where we can maximize our return and minimize the risk. So if you look at the background of this study, so let me talk about this study a little bit. So this is a study conducted as a part of consultancy done for a company called Multi-Commodity Exchange of India. So if you don't know what is Multi-Commodities Exchange of India, so they are the largest commodity exchange in India. So myself along with my colleague Professor Kumar, we did a consultancy for Multi-Commodities Exchange of India. So in that sense, this is a very applied project. Based on some real life research problem based on the market, we have conducted this study. And if you go to the background of the study, as I said earlier, there are a lot of investment opportunities. So I'm basically talking about financial assets. So we have financial assets and real assets. Real assets means people invest in real estate, right? That's a different thing altogether. So currently we are talking about financial assets because financial assets have a lot of advantages. So what are these advantages? Highly liquid. Suppose you have real estate, and if you want to sell real estate very quickly, that may not be possible. So one of the most important advantage of this financial asset is that it is very liquid. What is meant by liquidity? You can buy and sell at any point of time. So that is the advantage. So if you look at stock, right, you can buy and sell at any point of time. If you look at bonds, that also you can buy and sell at any point of time. Gold, I'm not talking about physical gold here, like jewelry. You may be accustomed with jewelry and all. I'm not talking about that, right? So gold is also available as a financial asset now. So when it is available as a financial asset, the advantage is that you can buy and sell at any point of time, right? So if you have jewelry, you have to go to a jewelry and sell that. But if you are having gold as a financial asset, see now gold is available as a financial asset, which could be bought and sold through a stock exchange. So this is known as gold ETFs. ETF means exchange traded funds. So people can take exposure to gold as a financial asset. It could be bought and sold from the stock exchange like a stock. So there are investment opportunities in all these spaces. People invest in stocks, people invest in bonds, people can invest in gold also. Gold is a commodity. This study basically deals with the fact that how these commodities help in portfolio diversification. What is diversification? As I already said, basically rather than including a few stocks or a few bonds in your portfolio, you create a portfolio which consists of various assets which will help in diversification. So this is using the fundamental basic principle, right, which we have learned. Don't put all your eggs in one basket. So that is diversification in most simple terms, right? So by including a lot of these commodities, the advantage is that you can maximize the returns and minimize the returns. So there may be teachers in this seminar who are teaching this course called Investment Analysis and Portfolio Management. So you can appreciate what I'm telling. Right, and as I said, in simple terms, what is this portfolio management? Basically, you are trying to maximize the return by minimizing the risk. So that is what you want, right? Especially when you are creating a portfolio, this is the most important objective. And another change which is happening in the country currently is financialization of assets, right? So I just mentioned about gold. Gold earlier, if you want to buy gold, you have to buy it as a jewelry or gold bar and stuff like that. But if you look at the current situation, you can go buy gold like a financial asset. I already explained that. Similarly, real estate also could be bought like a financial asset. So there is a product called REIT, Real Estate Investment Trust, REIT, that are actively traded in the stock exchanges. So this wave is happening in India currently, which is basically known as financialization of assets. So gold is financialized, it is converted into a financial asset. Real estate is also getting converted into a financial asset. I'm not talking about normal plot of land. Basically, whatever REITs, Real Estate Investment Trust, are available in India, those are commercial real estate. So this is also getting financialized. What is meant by financialized? All these assets are getting converted into a financial asset. So as an investor, they are focusing on this risk return dynamics. As I already mentioned, what is risk return dynamics? Maximizing return and minimizing the risk. Normally people say that if you want to get more returns, you have to take more risk. So in this diversification, we are focusing on maximizing the return by minimizing the risk. So best of both worlds. Right. Then I mentioned about this diversification. So what is the advantage if you include commodities in your portfolio? Because you know that people already invest in stocks, people invest in bonds. They're very familiar with that. So what is the advantage of including commodities? So gold is a commodity. I'm not only talking about gold, I'm talking about other commodities also. So I'll explain all those things in detail. So this is the background of the study. So as I said, people currently invest in equity, debt, and gold. So hope you are familiar with all these terminologies. Equity means stocks, debt means bonds of companies or debentures or even fixed deposit, right? Fixed deposit is also part of debt. And people invest in gold. So these are the most popular form. And there are other types of investment also. Nowadays, people invest in cryptocurrency and things like that. So I'm not getting into that because that is something new and the risk return profile is not very much known outside. So let us focus on these three popular financial assets which people invest in. So gold, I'm considering only financial asset because there are a lot of disadvantages with the physical buying of gold. As you may know, when you buy gold, you pay making charges, so which is taking out the return of gold. Even when you sell also, you pay those making charges. And then you have to put this jewelry in some locker. So there are a lot of advantages for physical gold. So when I talk about gold or any other commodity for that matter, I'm talking about the demat form, the financial assets, gold as a financial asset, which is available currently, so that is not a problem. So gold and other types of commodities. If I include gold and other commodities, how this is going to affect the diversification? So diversification, again, I'm repeating, maximizing return, minimizing the risk. Now, let us see the current returns. If I take these assets individually, See, I'm investing in equity, I'm investing in gold, I'm investing in debt. If that is the case, what are the returns? See, you know the difference between investor and speculator, right? See, people can invest in any financial asset, right? People can invest and people can speculate also. Say, for example, if you are buying the stock of Reliance Industries, people can speculate on Reliance Industries, people can invest in Reliance Industries. Now, what is the difference between investment and speculation? Investment, basically, they are investing for a longer time horizon. Speculation, they are investing for a shorter time horizon. In other words, whatever you are learning in finance, it is all about investment. Speculators, right? Speculators, they are not bothered about the business of that company or the financials of that company, balance sheet, profit and loss account. They don't look at all these things, speculators. Speculators just follow the trend. So there is nothing finance in speculation. So what I'm saying is that any financial asset you take, there will be speculators as well as investors. How do you differentiate between speculators and investors? Speculators take a short-term call, investors take a long-term call. So if you look at any business, the business is relevant only for investors because if I'm an investor, I will look into the profit which this company is making. Not only the historical profit, the profit this company is going to make into the future also. So all these things I'll take a look. If I'm an investor, if I'm a speculator, I don't have to know the name of the company also. What I should get is the past price trend of the stock or any financial asset for that matter. And using that trend, I will get into a prediction about the future and I'll trade. So this is the difference between speculator and investor. So please be very careful with this. So if you see somebody investing, buying and selling stocks, he or she may not be investor, he or she may be a speculator also. So all these possibilities are there. So I'm talking about investment. I'm not talking about speculation at all. Why? Because in speculation, there is no finance. What is finance? We look into the financials of the company, balance sheet, profit and loss account, cash flow statements. We look at the business activities of the company and what they are doing and how much profit they will make now, how much profit they are making now and how much profit they are going to make into the future. So all those things. So in my presentation, I'm addressing only investment, right? So investment in equity, investment in debt, investment in gold. So what is the peculiarity of all these things? And what is the relevance of including commodity into this portfolio? If you ask me about the relevance of speculators, why speculators are required? Because they provide liquidity. If all people are investors, right, you will not see buying and selling on a daily basis. So speculators are integral part of all these financial markets. Speculators are required because they provide the most important feature of financial market, which is liquidity, right? So this is the general point, and now I'm going to talk about this long-term investment in these individual assets. So let us take a look at the individual returns from all these assets on a long-term basis, because that's what investors are interested in, right? Investors are not really worried about the fluctuations, short-term fluctuations and stuff like that. So let us take a look at the long-term returns of all these assets individually and not as a portfolio. So let us see that. So this is you are able to, hope you are able to see the returns there. Last 10 years return, 2011 to 2021. So this is not the return till this month. So this is the return till March 31st, 2021. So you can see the returns. So annualized returns. So this is the annualized returns. You might have learned about compounded annual growth rate, right? So this is not the total returns in 10 years. This is the return which they would have got on an annual basis for the last 10 years. So bond gave a return of 7.21%. Equity also, I don't know whether you have learned this. I'm asking the BCom students, right? So equity may be classified into different categories: large cap, mid cap, and foreign equity also. What is the difference between large cap and mid cap? So there is this concept called market capitalization. What is meant by market capitalization? Number of shares issued by the company into the market price. So large companies will have larger capitalization. Small companies will have small capitalization. And there is a category which is coming in between. They are known as mid cap. So in this study, I've taken only large cap and mid cap. So if you ask me how this large cap is classified, you take the market capitalization of all these companies in India. You take the top 100, so that is categorized as large cap equity. So normally all these are proxied by indices. So we have indices like Nifty and Sensex, right? So those are large cap indices. So I've taken a proxy which is nothing but the Nifty for capturing the large cap index, and that has given a return of 11.26. And the Nifty mid cap index is taken for capturing the medium-sized stocks, and that has given a return of 12.96%, annualized return. And now people can invest in foreign equity also, right? So there are mutual funds which capture NASDAQ returns in the Indian stock market, and I've taken that as a proxy, and that has given fantastic returns, actually 25% return. See, if you are buying a foreign equity index, basically you are buying two assets. You are buying that index. So this is basically NASDAQ, and over and above that, you are taking a call on the dollar also. If dollar is appreciating, your returns will be more. So that is how this foreign equity, they have given a higher returns, 25% over the last 10 years. Gold has given a return of 9.12% the last 10 years. If you look at the next column, you can see the risk. You might have learned that the risk of any company is measured using standard deviation. So using that standard deviation, what is the risk? So higher the standard deviation, higher the risk. Lower the standard deviation, lower the risk. So if you look at the in terms of risk, bond is having the lower standard deviation. So that is the least risky product in this category, out of the category of assets people invest in. And if you look at the lowest risk asset, the problem is that is having lowest returns also. So this is why you create a portfolio. So by mixing all these assets, you will be able to increase your returns and minimize your risk. Whereas if you look at the mid-cap equity, that is having the highest risk in this category. So my objective here is how to increase the returns by minimizing the risk by including various assets. And there is a ratio called Sharpe's ratio. Again, if you are learning or teaching IIM course, there is this ratio called Sharpe's ratio. If you ask me what is Sharpe's ratio, if you have not learned that, let me explain it in simple terms. So it is nothing but the returns for each unit of risk. So basically you are dividing these returns by this risk. So if you divide returns by risk, you get Sharpe's ratio. Right? So higher the Sharpe's ratio, that means that higher the risk-adjusted returns. So for each unit of risk you are taking, how much is the rate of return? So that is what it is measured. So now let us come to the core objective of this study. So before that, let me introduce the commodities also to you. So what are the commodities we are looking at, or we looked at? Commodities are broadly classified into 4 categories. Here I have included 3. So what are these 4 categories? Bullion, gold and silver coming in bullion. They're known as bullion metals. Then base metals, aluminum, copper, lead, nickel, zinc. So those are base metal commodities. Then we have energy commodities like crude oil, natural gas. So all these commodities are considered. And we are trying to explore what are the commodities which will give the best diversification. And what are the proportion of those commodities which will give the best diversification. So if I summarize our key research questions, so this is like this. So to explore the diversification possibilities of select commodities that are available to an investor in India through commodity futures. So currently, only gold we have a financial asset. All other commodities we have to take the futures route. So it's a type of, please understand that there's a type of financial asset through which we can take exposure to commodities. If I take physical buying of commodities, right, we have all these problems which I've mentioned for gold. We have to keep it in some location. So all those things are there. So the easy way out is by commodity futures, which are currently available. And the MCX is the company which is offering all those financial assets. They offer commodity futures in all these categories: bullion, base metal, and energy category. So our key research question is, if I include these assets along with stocks and bonds, what is the diversification I'm going to get? So that's what we are exploring currently. And if you look at our study, we have considered all the commodities which I mentioned, bullion, base metal, and natural gas. All these commodities we have considered. And one of the easiest measures or most convenient measure used for testing this diversification possibility is correlation. Hope you have learned correlation. So correlation talks about the relationship between two variables, and it varies between -1 and +1. So +1 means perfect positive correlation, and -1 means perfect negative correlation. So what is meant by negative correlation? Say suppose two assets are having correlation -1. What is the meaning of that? If one asset increases by 1%, other asset decreases by 1%. +1 correlation means what? If one asset increases by 1%, other asset also increases by 1%. So in real life, the actual correlation will be in between -1 and +1. And mostly you will not get in financial markets, you will not get assets where the correlation is towards negative side. So if the correlation is towards +1, and you can move to the left side, right, towards 0 first, then to negative side. So if the correlation is less than 1, that means that you are getting diversification. How do we measure diversification? Using correlation, which means that at a correlation of -0.5, you get a higher diversification than a correlation of 0. Or at correlation 0, you get higher diversification than a correlation of 0.5. So if you keep that in mind, actually we can test the correlation possibilities of all these assets, all these commodities versus equity and bond. So that's what we have done, and let me show you the results. So hope you are able to see this. Okay, let me increase the size. So hope you are able to see this now, and you can see that, right? So if you look at Nifty is having best diversification, right? So this there is less diversification here because it is closer to 1, and with bond it is having good diversification because it is significantly lesser than 1. With gold it is having the best diversification because it is going to the negative side. So the more you are farther away from +1, you have more and more diversification. You can see that good diversification with commodities. Similar is the case with mid-cap stocks, right? So the best diversification are with commodities. Bonds also same is the case. Bond is having fantastic diversification possibility with the commodities. Similarly, N100 is nothing but the foreign equity. Foreign equity also more or less the same trend, and foreign equity is having good diversification possibility with Indian index also because it is significantly lesser than 1. So you can see that, right? Bond. So anyway, you can look row-wise or column-wise. So whatever is marked in green, those are the best diversification possibilities. This is an exercise where we created a portfolio of stocks and bonds and included all these commodities. So if you include these commodities, what are the advantages? And clearly we can see that there is a diversification potential here, and the risk is minimized and the return is maximized. So if you look at the portfolios which we have created with this, you can clearly see that, and we have created those portfolios which are having the best diversification benefit. Using Markovs framework, again, this IIM course, if you are learning or if you are teaching, you know that there is this very famous theory called Markovs portfolio theory. The simple idea of Markovs portfolio theory is that the portfolios are created in such a way that return is maximized and risk is minimized. So we have explored all the possibilities. So we have not put any constraint. All possible possibilities: equity, large cap equity, mid cap equity, foreign equity, bonds, and various commodities. So what is the result of that exercise? So this is what I'm showing you. So the best set of portfolios. What is meant by best set of portfolios? I've selected only those portfolios which are having a Sharpe ratio of more than 1.5. And what is the significance of that 1.5? I'll tell you. Individually speaking, no single asset is having a Sharpe ratio of less than 1.5. So by mixing all these assets, we have created hundreds of portfolios. Out of that, I've selected only those portfolio which is having a Sharpe ratio better than the best individual asset. So the best individual asset is 1.4, and the best portfolio, best set of portfolios I've created. So that's what we have done. These portfolios which are having Sharpe ratio of greater than 1.5, what are the salient features of those portfolios? So result is interesting because all portfolios will have 5 assets. What are those 5 assets? Bond is compulsory, gold is compulsory, natural gas is compulsory, and equity is compulsory, either Nifty, mid-cap or foreign equity, and base metal is also compulsory. And what is the range? Weights, right? So normally when you create a portfolio, you have weights for each of those assets. Say, for example, suppose you are creating a 10 asset portfolio and it is equally weighted. The weight of each asset will be 10%. So what are the features of those portfolios which are having Sharpe ratio greater than 1.5? So hope you are following what I'm saying. So we have created hundreds of portfolios. Why hundreds of portfolios? Because I have all these commodities along with stocks and bonds. I can get hundreds of portfolios. And we have selected only those portfolios where the Sharpe ratio is more than 1.5. What is the feature of, what are the basic features? 5 assets are compulsory: bond, gold, natural gas, equity, and base metal. And these are the range of weights of those portfolios. So the lowest is 5.68 and the highest is 80.58 for bond. So those portfolios which are having highest Sharpe ratio. What is the significance of Sharpe ratio? I've already mentioned that. Highest risk-adjusted returns, best diversification, best returns for minimal level of risk. So I've given you the weights of all these portfolios, maximum and minimum of each of these assets. All these assets are compulsory, but what is the maximum and minimum of all these assets? So that's what I've given here. So all these assets are mandatory for creating the best portfolios. Now you may be interested in seeing what are those risk and return levels. So that's what I'm giving in the next slide. So I've just taken 2 sample portfolios for you. One is the lowest risk portfolio using all these assets, any combination. Second one is highest Sharpe ratio portfolio with the best risk adjusted returns. You see the Sharpe ratio here. Here it is 2.3. Risk is lowest, which is better than the individual assets. So individual asset, the best is 1.4, and the return is something like 7%, right? So look at the risk here. When I include all these assets from that lowest level of risk, I think that 5% it got reduced to 3.86, and the return got increased to 8.89. So basically, we do an optimization, right? You might have learned linear programming. So how this is done? Basically, you do an optimization. What is this optimization? You maximize the return and minimize the risk, which we can do. And Sharpe ratio is given here, which is good. And you can see that risk got reduced, return got increased. This is the lowest risk portfolio. And this is interesting because all the individual assets used for creating those portfolios, these are the Sharpe ratio. And my Sharpe ratio got increased here, and my return also got increased. If I look at the highest Sharpe ratio portfolio, the portfolio which is offering the highest Sharpe ratio, these are the weights. So lowest risk, these are the weights. Highest Sharpe ratio, these are the weights. And the risk is something like 4%, which is lower than the lowest risk assets, and the return is also maximized. So that's what you can see here. And out of these hundreds of portfolios, you created portfolios in such a combination that you get the lowest risk portfolio and you get the highest Sharpe ratio. So these are 2 sample portfolios from the set of portfolios which are having Sharpe ratio higher than 1.5. Right. So this is the main part of the study. So I'm just presenting only few parts here. Now, what are the key findings and recommendations of this study? So the presence of this commodity enhances the risk-adjusted returns. You have seen that individually speaking, the best Sharpe ratio is 1.4, but when you include all these things, Sharpe ratio just got increased. Basically, you minimize the risk, maximize the return. And second point, financialization of commodities is absolutely required for deriving the diversification benefits associated with commodity investing. See, suppose I want to include commodities in my portfolio. If it is available in the physical format, it is very tedious. So, financialization of commodities, MCX is providing that through the futures route. You can buy as a financial asset. Suppose you buy copper, you don't have to buy it physically. It is available as a financial asset. What is the advantage of financial assets? All these things will not be kept physically. So if you want to keep it physically, you require a go down, and you should have certain conditions for that. Otherwise, it may get rusted. So those kind of problems are there. But if it is a financial asset, you can keep it in the demat form. So I said, right, gold is currently available as a financial asset. So there you will not see gold. Gold is kept in the demat form. What is demat form? It's kept in the electronic form, right? So then commodities in renewable energy, energy efficiency and resource scarcity may help in the generation of additional alpha. So these kind of commodities, right? Say for example, say now people are talking about reducing pollution and all, right? Now you might have heard about the increasing popularity of electric vehicles in India. So if you look at electric vehicles, right, they are using battery. So battery, the major component is lithium, right? So if you look at this lithium, actually a lot of these metals go into the manufacturing of that lithium battery. So commodities are contributing in that space also, and that leads to the creation of additional alpha. What is meant by alpha? Excess returns. So how excess returns could be created. So that is also very evident. So when you are having higher Sharpe ratio, that essentially leads to higher excess returns. Right? An exclusive spot exchange for commodity spot trading platform with the existing exchange should be created, and already it is created. If you look at gold, right? So already they have announced the starting of gold exchange, and I'm just giving some part of the study. Right, and those of you who are more interested in knowing this, we have submitted a detailed report on this. So it is available in the MCX website. The link is given there. So I think I'll stop here. If you have any questions, so not only on this topic, on any of the topic, right? So you can ask the questions now. Right. Yeah, so I'm open to take questions. So thank you for inviting me to deliver this lecture. So wish you all the best for St. Mary's College and specifically Commerce Department, and all the best to other participants also. So I can take any questions. So please feel free to ask your questions. Please raise your hand and ask your question. Thank you. Yeah, don't hesitate. No? So whatever is coming to your mind, you can ask. So don't worry about the quality of questions and all. You can ask on any finance topic. If you have any questions, otherwise we will stop. So I can take. So if you are asking a question, please tell your name and ask your question. No questions? You can ask on any finance topic. No? That's also fine. So if there are no questions, right, then we have to stop. Otherwise, I can continue also if you are asking some questions. Otherwise, let us stop if there are no questions.
All right, I hope so no one is having any queries. Well, thank you for sharing your valuable time with us. It was quite informative. Now I welcome Malavika Vijay to present the word of thanks.
Okay, am I audible?
Yeah.
Okay. A warm good morning to one and all present here. Myself, Malavika Vijay from 2nd BCom. On this wonderful occasion, it is my privilege to propose a word of thanks on behalf of this extent, making today's program a resounding success. Big thank you to Dr. Sony Tomas, Associate Professor, IIM Kozhikode, for giving such an effective and interesting session on the topic investment portfolio. It was really informative and useful. I thank our principal, Dr. Sister Maggie Jose, and our HOD, Srimati Ruchi Mehta, for arranging a wonderful session. I like to express a special gratitude to Srimati Haridasiyar and all other faculty members for putting efforts to make this program a great success. Special thanks to the Department of Commerce, St. Mary's College, for conducting such a useful meet. Last but not the least, a heartful of thanks to all the students for their wonderful cooperation. Once again, I thank each and everyone present here. Thank you.
Thank you, Malavika. Now, the section had officially ended. Thank you for both the cooperation and the time you had been sharing with us. Thank you.
Thank you. Thank you all. Bye.